You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Ladies and gentlemen, I got a great guest lined up for you today, but before we jump into that, if you're watching this on YouTube, go ahead and hit that subscribe button for me. And if you're listening to this on iTunes or Spotify, go ahead and subscribe and leave us a 5-star review. Now that we have that out the way, let's go ahead and get to today's guest. Is Pankaj Sharma. He is a second generation multifamily owner, operator with over 20 years experience in the field. His current personal portfolio consists of 2,000 units in 5 major markets, and he's in Eastern Pennsylvania. His latest deal closed in July of 2019 when his company purchased a $50 million fixer-upper in Harrisburg, which is the state capital. Recently, Pankaj started Sharma's Karma, a YouTube channel. And I actually listened to a couple of the videos there, and man, it's a great channel, man, great content. So you guys definitely check that out. And it was a way to document his journey and a way to give back. Karmacast interviews can be found on various other platforms like iTunes and Spotify. Hey, man, how you doing today?
Hey, I'm good. How are you?
Good, man. I really appreciate you jumping on the show today, man. I know you're going to bring some awesome content to the listeners today, so let's jump into it, man. How did you get into real estate?
Well, I grew up in the business a little bit. When I was 10 years old, my father did his first deal. And so from the age of like 11 to 12, I was in real estate because I was painting apartments. I was cutting the grass. I was holding the toolbox for my father, watching him figure out this whole deal. The apartments in my future. My future was like, they say that you're going to do something else other than what you're seeing or whatever you're growing up into. Yeah. So it wasn't something that I planned to, in my mind as a child, at least when we first came across it, that was something that I was going to, that's your thing, Pops, you do that thing, I wasn't going to get into it. But as I got older and, things I got more practical and wiser, I think, as I got older.
Right.
And it just seemed like the best fit. I started off with the property management aspect of it, of being a property manager.
Yeah.
And that's not my thing, but it's an important aspect of the business to this day.
Right. That
we manage our own properties ourselves. We're real estate investors, but we're also property managers, owners and operators.
Right.
And so through the years, I've just done everything from from the little light maintenance to just being a manager to and even my kids, they're like 15 and 16, they're 15 and 17, but even when they were like 14 and 16, we started them off like, working with the cleaners.
Yeah.
Just starting them as a base of getting them so as you grow up, and appreciate, you can understand where all the different people are experiencing on a day-to-day because you've done it yourself.
Right.
You're able to relate to people. So tomorrow, if they're like the owner of the company, they understand all levels.
Yeah. Man, that's very smart. And, I think you guys are wise to do that, especially with you building a generational deal like that, man. That's what my podcast is all about, building generational wealth. And, the one way to keep that wealth going is to, teach the next generation, what to do with the assets. So you guys are very smart for doing it that way.
Right. So the third generation is already in gear. They're in their minds. They see themselves as doing what we're doing, possibly other things, and it affords you to be able to do other things as well. If you have a passion in other areas of life, you can do that. I think for a long period of time, I had a conflict because I thought my passion was somewhere else, doing something else with somebody else.
Yeah.
And was really into a lot of holistic type of things. So I thought I wanted to open a holistic center and do other things like that.
Yeah.
And tried a lot of different things in that area. And, real estate always paid the bills for me. And real estate really gave me the freedom to do what I want when I wanted it, the way I wanted to do it. And when I went from like a worker and a manager to like an investor and owner operator, I realized like, this is my thing, like being an entrepreneur, being a business person, doing it my way, being able to express my creativity, my vision, and work with people, be a leader.
Right.
You need those leadership qualities because, you know, everybody's looking to you. And I feel like even today I had a call this morning, man, it's like two kids fighting, you
Yeah.
know, maintenance man and a manager, like two kids. So it's like, I got a big extended family of all these.
Right.
Some people are not everybody's my kids. Some people are older than me. They feel like my aunt or my uncle, you know, so but I'm working with like all these people
Yeah.
that we're a family, like, you know, we're a big family.
Yeah. And that's awesome, man. Very, very cool. So, you know, I normally ask, you know, why did you decide to invest in this asset class? But I mean, this has been a family business, you know, for you know, going on 3 generations now. So let's just talk about, you know, what is it about multifamily that you guys love so much that you know haven't decided to go any other direction?
Well, multifamily is something that we know, you know, and now you know, growing up, I always wanted to get into commercial real estate and other aspects like retail and you know, to do other things.
Yeah.
But it wasn't until recently of late in the last few years that I realized, like, luckily we stuck with multifamily and that was, we put our eggs in one basket. We didn't diversify in the real estate game. And I could see the value over the years of how properties have appreciated. And now there's a real popularity or even mania regarding multifamily that I'm seeing
Yeah.
that I've never seen before. So we would never be like 10 years ago or even 5 years ago, we would never be able to forecast what we're seeing today. I don't believe,
Right.
because trends have just changing so rapidly, you
Yeah.
know,
Yeah.
things are changing. Just even 5 years, the game has changed in the last 5 years.
Right. Right.
You know, so I feel grateful that multifamily is a stable asset. You know, it doesn't mean that people don't lose money in multifamily. People lose money all the time. You know,
Yeah.
so I don't want that myth to be broadcasted, but
Right.
you got to do it right. You got to manage it right. I mean, we've made a whole business off of, you know, managing properties or taking over deals that people just were losing money on.
Right.
You know, and they had to get out. And we built our whole business on taking what was seemingly broken and fixing it and
Yeah.
repairing it and managing it, you know, in a different way and
Right.
being on top of it. So that's been our whole business model, basically, is finding the distressed properties that are, they need to get out, you know, have a motivated seller, or the seller's just time for him to sell,
Yeah.
and buying them and managing them for a long period, you know, and playing a
Right.
patient game with them.
Right. Right. So, how are you guys finding these opportunities that's distressed like that? Because I mean, the market is so hot right now. It's almost like you would think it's impossible to find them, but you guys are finding them.
Yeah,
So, how are you getting them?
the inventory is really slim pickings here in our area. And
Yeah.
this deal was pretty much an off-market deal. It came to us, you know, because of our reputation with one particular broker brought it to us.
Yeah.
And I guess this gentleman was looking to sell for a while, and he had people interested in certain, like, there's 5 properties in this deal, the $50 million deal. There's 5
Yeah.
properties. And he had people were interested in like 3 or 4 of the 5, but there's one building was called a high-rise building that nobody really wanted to mess with. And the only reason why we got the deal is because we were the only ones that were willing to do the whole package
Yeah.
and had the stability that we could get the whole package, because you know, I mean, it was so like most of the times when you buy a deal, the property can hold its own mortgage, right?
Right.
Even if you
Right.
do like a 30% or 40% down, or even a 25%, 20% down, the property can hold its own mortgage. This property could not hold its own mortgage. We had to bring in money in order to do this deal. And because of
Wow.
like some of the properties that are, you know, the equity we had in other properties, we were able to pull that equity out and do this deal. You know,
Yeah.
we don't syndicate, we buy our own deals. And
Man. Let's just stop there for a moment, man. Because it seems like everybody that's out there that's taking down huge deals. I mean, you just took down that $50 million deal, and you say you didn't syndicate it. That's powerful, man.
thank you.
It really is. You know, and it's kudos to your family on building up something of this magnitude to be able to go out and buy something of this scale, man. it's definitely you guys set the benchmark of where everybody should be shooting for. I mean, you really have, man. That's pretty awesome.
We usually would do a deal a year, and the deal a year would probably be like 100 units here, 200 units, something like that, by one property. But this is 5 properties all together, one deal. It was the largest deal that we did all at once. And I went from managing about 1,100 to now I'm managing 2,000. So I almost went to doubling.
Yeah.
And I was comfortable with the 1,000 units that I had at 1,100. Right. I was comfortable there. I really didn't want to pull up my sleeves again and get down and dirty. Really, it wasn't my thing. But I surrendered. I just said yes.
Yeah. So you guys are staying in Pennsylvania, or are you guys open to looking at other markets as well?
We've always been in Pennsylvania, and now all of a sudden, Willie, it's like I've been seeing in the last few days, it seems like all of a sudden I'm seeing all these large portfolios come available. And it must be, I think, something's going on. All these people all of a sudden are selling thousand unit portfolios just out of the blue. Like I hadn't seen this. Like I'm starting to see these emails jump across the screen.
Yeah.
And a bunch of them are in Florida. And, I'm interested to look and learn.
Yeah.
But if I go outside of the state, it would have to be for a bigger play. It would have to be like maybe 500 units and above.
Yeah.
I wouldn't be chasing, I don't think, like 200, unless it's like a steel deal of 200 units or something like that,
Right.
Which is very unheard of in these days and times. Everybody's like, they're like, okay, the market's about to change. Let me get rid of let me upload all these C properties. Maybe they got another deal to parlay that money into. I don't know where they're going to park that money next, but they got to have something if they're going to be selling these big portfolios. They got something planned up their sleeve, right?
Right. And it could be, man, that, they're seeing the writing on the wall, and, we've been in this economic expansion for so long that, a correction has to come at some point.
Yeah. They're like, everything, like, let me get out now. Well, I know I can get that good money for it.
Right.
Because 6 months from now, it might be a whole different bar game, So like right now, I can get top dollar. We're at the top of the market. People can get top dollar. Let me get that top dollar now. But at the same time, because of our tax laws and things of that nature, unless you want to pay a lot of taxes, you got to have something else to put that money into.
That's right.
You can't just like say, okay, it's the top of the dollar, I'm going to sell.
Yeah.
You got to have an idea or something to do with that.
Right.
What are you going to do after you sell?
Yeah. And that's the challenge, man.
I'm real curious about that. Like, I'm curious about, okay, they're selling, I understand that, but where's the money going? What they got? What do they got planned? Are they going back into retail now because retail's better, or they got triple net lease? What are they doing?
Right. That's a very good thought, man. Very, very curious to see where that does happen at, because there's always going to be up and down cycles in every asset class. And, multifamily may be up here right now, but they may see an office that's down here, and, they jump in that segment or that market and crush it there, ride that wave.
I'm thinking of taking a trip down to Florida, even if it's just educational,
Yeah. The screen had froze up there for a second there, but you said you were thinking about taking a trip down to the market just to kind of get educated on what's going on.
Are you just in Pennsylvania? So yeah, we're in Pennsylvania, but eventually if a good deal draws me somewhere, I'm definitely open.
Yeah. Now, you said when you're looking at your deals, you're looking, 500 plus. Why is that number so important to you as far as it being 500 units versus, I know most guys I talk to on the show here, they say 100 units plus. Why is 500 such an important number?
I'm saying that if I go out of town, if I go far away, I want a larger, I'd be more attracted to do it for a larger portfolio. You know? If it's down the street from something I already have, even if it's 30 units, I'm willing to look at it. If it's close to something, if I can manage it from one location.
Gotcha. So it's more
mostly.
Yeah. So it's more of a economies of scale.
It's kind of key. So that's just my number in my head. Like if it's 300 to 500, because the larger units you do make a lot more money.
Yeah.
Make more money. The largest one property I got 2 properties. One's 294 units. The other one's 273.
Yeah. Yeah.
And those larger properties, we're seeing that, it's you can scale. It's worth the scaling if you can do it.
Right, right, right. Got you. So, you guys are buying a lot of properties and you're managing yourself. So you got a pretty good pulse on what a property should look like as far as financials go. When you're underwriting a deal, like what are the red flags you look for to say, hey, this doesn't make sense at all?
Well, when you do you're talking about the underwriting is like before you do due diligence, right?
Yeah, yeah. Before you
Just
put an
kind of like
offer in
looking
on
over
it,
it. At that point, you don't know too much. You're not seeing the red flags. The red flags are really going to pop up when you do your due diligence. Because at that point in underwriting, you're just seeing the overlay. You're seeing a
Right,
couple numbers that they're presenting to you. You don't know anything about those numbers. You don't know how real those numbers are unless you're in
yeah,
that market.
right,
You're not in that office managing, doing a property manager. So even those numbers that are presented to you, those are just, you take them with a grain of salt kind of numbers.
yeah, yeah.
You
Well,
know?
let's talk about when you get it under contract then, and what do you look for as a property manager? I mean, you kind of
So
have a
now you're doing your due diligence, and in the due diligence, that's when the real red flags pop out. That's when you start seeing the leases. You start going through and seeing each lease. You go see looking at the rent roll. You're seeing what's the trailing 12. If you get the trailing 12 is one thing that you can look at before you actually get a signed contract.
yeah,
But that's about it. The trailing 12 is the only indicator you really have of performance,
yeah,
of past performance and recent performance. And if they're giving you an honest NOI, obviously that's going to be in the sales, in the sales package.
right,
Look at the NOI and to see, the units, what they're getting gross and all that kind of thing, and taking out the expenses, seeing the expenses are about 50% of that.
right,
And
right.
the judge, looking at the thing. But as you get into the due diligence, that's when you really get to see, when you walk the units, each unit inside, because even when you're taking the tour, you're just going to see the surface.
Right.
You're going to see one or two units. You're not going to see a whole lot. You're going to see just the surface of what's presented. It's not until the due diligence you see what's underneath the surface.
Right.
So
Right.
unless you really you're close as a property, it's in your market, you kind of know already, you got a feeling or vibe, you have the inside scoop on the property. So when they do the due diligence, that's when you're looking behind, it's like you looking under the hood
Yeah.
of the car. And that's when you can see, what's going on with the leases, with the rent roll, with the occupancy.
Right. 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 So, man, there's a lot of people that's trying to get into the multifamily space because of how hot it is right now. So, what is the biggest mistake you're seeing people make right now that's getting into the space?
Honestly, I have to first say that I'm not watching a lot of the new people, so I can't really say per se. I can only
Right.
speculate that, okay, this is what a lot of people right now, like they said, there's this popularity, there's this mania amount more multifamily, and the people can just be happy to get a deal. One of the things that I'm just speculating, people could just be like, oh, I got a deal, I'm happy to get this deal.
Right.
Money is cheap right now. One of the things that I talked to a friend of mine, his father's looking at the deal now upstate in Pennsylvania, and he's kind of was inspired by our channel, our YouTube channel. And he's already got a bunch of single houses.
Yeah.
And now all of a sudden, like a 9-unit popped up. And he kind of knows the owner and he's talking the deal. The mistake that I'm seeing him make, or the challenge, is the financing aspect. Be careful about the financing.
Yeah.
They'll lock you in for 5 years, but then after those 5 years, you don't know where the interest rates are going to go.
Right.
We like to have it locked in for the due diligence, for the period of the mortgage.
Yeah.
That's one thing that's very important. Like working with the lenders. The lenders are about making their money.
Yeah. Yeah.
They'll throw you the interest only, and they'll give you all these, I got this package and I got this, this product and I got this product, but find the product that's really gonna. So right now we might pay a little bit more for interest, but we'll lock that interest rate in for the lifetime and do a self-liquidating mortgage for 15 years.
Right.
You pay a lot. So a lot of people, they just want cash flow. Cash flow is like the big word. So by getting cash flow, then they get the interest only payments and stuff. But then down the road, you don't know how the market's going to change.
Yeah.
If I can pay the bills in the beginning and pay the interest, then I know I'm good in the future. I'm confident and I'll be able to pull through if things change.
Yeah.
If
Yeah.
I get into the deal and I'm getting interest only, then all of a sudden, what are you going to do after the interest only? You're going to start paying. Is it still going to make sense at that point?
Right, right, right.
So I
And
think,
I will say too that a lot of reasons why you see these syndicators going for that, because they have those investors that they bring in on the deal, and they got to give them a certain return. Whereas you guys are buying as a family, so you're not so much worried about what you're getting today, but you're building this generationally. So your thought process is completely different than most syndicators are that's looking at buying commercial real estate, I would say.
yeah, I spoke with a lender the other day. Somebody was just trying to like make a connection with me, and he was telling me about like equity preferred loans and those type of things where you can just put in like 10% of the
Yeah,
down cost, and they'll put money. But the thing was that you're giving up control. At some point, they can vote. They have voting rights, and they have these type of rights. You lose that control, and I gotta listen to the bank. I gotta listen
right,
to the insurance company. I gotta listen to the government. I got enough
right.
partners in the deal to listen to. I gotta listen to my wife.
Right, right.
I don't know how everybody else does it, but they gotta listen to all these other investors, or
Yeah,
and especially
that's a
when you got
that's a good
institutional
point, man.
money into play and you got institutional investors, they're not playing. They
Right.
want it their way. If you're not able to perform to the numbers, then they can do things, and they can
Yeah,
take back control and things and
yeah,
change the management, or, force you to do things.
yeah.
It may not make sense to you as the owner operator.
Right, right. And I had a guy reach out to me on LinkedIn, same kind of product, pitching that to me, and I just didn't like it because, like you said, you lose a lot of your control when you go that route. I mean, you really do. And if they want to sell at year 3 or 4, you ain't got no choice but to sell, even if you want to hold on to it. Like
Right.
they brought all the money to the table pretty much. So, I mean, you're kind of you kind of put in a bad situation in that scenario. So, that's why I dislike it, but I'm pretty sure it works for some people.
Yeah. So be careful. We had the last bomb that was dropped back in 2007, 2008 was because of predatory lending. Now you have lending. Now it's just a little more packaged a different way. So that's the only thing I tell people, new people especially, be careful about the lending. Learn as much as you can about the lending, because it might look sweet in the beginning,
Yeah.
but in the end, that's what you want. You want to start. Successful people
Right.
start with the end in mind,
That's right.
right?
That's right.
Other people they just happy to get in, and then
Yeah.
figure it out, and that's cool too. Get in and figure it out.
Right.
But be careful when you sign on that dotted line. You're signing on the financing. You're accountable to a lot of things. I mean, I know a lot of big
Absolutely.
guys. They got non-recourse loans. They can walk away, and and then
Right.
the investor's going to take on the syndications. You're going to see a lot of investors take a haircut
Yeah.
when things start changing, and all of a sudden the people be like, "Oh yeah, I invested this much in this deal, and this much in this deal." When things start changing, they're like, "Oh well, now we got to pay the mortgage, or we got to." And
Right.
then you're going to have also another key thing that a lot of people are not talking about is a lot of the properties they're buying C-class properties, and C-class properties are now 50 years old.
Yeah.
When something's 50 years old, there's going to sometimes be major capital expenditures, and to have that cushion and to be able to take care of those expenditures and you still pay the investors, that's going to be very hard at some point.
Right.
When pipes start going bad, I'm talking about the underground pipes, the pipes that are feeding the water to the buildings,
Yeah.
and those type of things from 50 years ago. I'm not just talking about the roof. I'm talking about like major expenses come up in these older C-class properties.
Right. 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 Definitely something to think about. All right, man. So let's segue into the next segment of the show. It's a deal deep dive, and I definitely want to look at this big portfolio you just took down. Let's look at how many units it was. What was the value add play that you guys seen on it, and the kind of debt that you put on it.
So it's a $50 million deal, and we put out of pocket, we put $5 million plus the closing costs, which probably another 1.5 million,
Yeah.
closing costs. So we got in out of pocket money is like you say between 6 and 7 million,
Yeah. Yeah.
right? And so 15 million of that was a refi on a property that we had purchased for less than 5 million 20 some years ago, 24 years ago.
Yeah.
That property is now valued at 25 million,
Wow.
probably easily.
Wow.
We were able to refi that property and take 15 million out. So that five plus the 15 is 20 million.
Yeah.
That's 40% right there, equity.
Yeah.
And then not fully equity because we got the refi. We're going to pay down the 15 million, but then that's 40% down that we have. And then the other 30 million is a mortgage on the properties, a blanket mortgage over the 5 properties.
Yeah.
So that mortgage is a 25-year mortgage, which we usually do 15 years, like I was saying. But this property, because we wanted, the bank said you should have a little more room. And like I said, these properties were not that, they were very distressed.
Yeah. Yeah.
You know, it's like a big community here. So it's where all the government is and it's a major city, you know.
Yeah.
I think we freeze. Okay, we're back. So Harrisburg is a major, it's the capital. And it's a little out there compared to like the areas that we're used to. But my brother who has another 2,500 units, he's been in Harrisburg for 10 years. I have one property there for I had a 74 unit already there. So that I bought like 4 years ago.
Yeah.
So yeah, that's the deal. That's the breakdown of the finance on it. And
what was the total unit count?
828 units.
828 units.
So we got them about 60,000 a unit.
Okay. Okay.
60,000 per door.
Yeah.
Somewhere in that area, which is hard to find these days.
Absolutely.
My area. You know, you're lucky. I haven't seen anything for $80,000 a door.
Wow. Wow. So yeah, that was a good deal on the buy, you know.
And somebody else just sold a property for $95,000 a door or $98,000 a door in the same city.
Yeah.
626 units in the same city. So prices are going up. And the good thing about Harrisburg, they're not like building a whole lot of apartments there.
Right. Right.
There's not a whole lot of crane. There's only one crane in the city, and that crane is building like a government building.
Yeah. Yeah.
So there's not a whole lot of product being developed and built there.
Yeah.
New product, which is just fine too. That's good. That's one other market we're in Allentown. They're building a lot of new product. They build a lot of luxury units and stuff, and that market has really shot through the roof.
Yeah.
You know, even though our properties are a different class, it's helped us to level up our game. But like the people who are renting those properties are not in our competition to us anyway.
Right.
People going to rent those apartments, not going to rent, C-class properties probably.
Got you. Now, what was the, I know one of the buildings were pretty distressed, but, what was the value add play that you guys were going to put in an action on this?
There's a lot of value add. There's nothing but value add here. We're adding a lot of value every which way. I mean, I've already done new roofs. I've done like a whole block of concrete, over 50 grand just in concrete, just a sidewalk, a whole block. Yeah. Painted outdoor shutters, doing a lot of landscaping. Now I've got one property that there's just a lot of gutters and squirrels and stuff. And so we're going to spend about another 50 grand there, just reinforcing and doing all the gutters and, making sure that all the fascia and everything is sealed up so the squirrels can't get in and create more ruckus like they're doing. So, I mean, every which way, there's just a lot of things to do. So we just got to pick and choose our battles one thing at a time, what's most practical. I've tried to, the one building that was the high-rise building that got us the deal, I wanted to get all the other properties strong and then kind of focus on that building.
Yeah.
So that, because if I went there, it might have just kind of consumed me all the way.
Right.
So I wanted to get the other ones strong and build their base up. But the tenant base was so unique there. I'm being special with my word. Yeah. It was so unique that we just had to do a lot of cleaning out. Yeah. Because they just was like fogging up mirrors. You can move into apartment, I don't know. Yeah. They just want to fill it up to the rent roll. Right. The deal was very rushed. We didn't have the time to do our full proper due diligence. He just wanted to unload the deal. He wanted somebody to buy it. And initially we walked away from it at one point. I didn't sign it.
Right.
We came close to sign it, didn't sign it. Then a couple months later, they came back to us again. We got a better price, better terms.
Yeah.
And the person who was like really pushing gave us a lot more time,
Yeah.
to get it together. Because a deal like that, with the bank and everybody looking at it and working out everything, it took a bunch of months to close
Right.
it.
Right. Right.
We might have signed the agreement in February, but we didn't close it until July. And we thought we'd close it at the end of May. Then
Yeah.
went to June, and then it finally went to July because there was
Wow.
just so many things to work on. We were faced with a lot of shut-off notices right as we acquired the property as well, because a lot of bills were just utility bills. A lot of bills were just went unpaid.
Dang.
And so we had to like deal with a lot of vendors coming to us, and we were saying like, look, we bought the property, we didn't buy the debt. Sometimes we had to pay the debt. Sometimes, most times we just had to, but we, you want the person before you take over a deal usually, and you have the time to take care of any, odds and ends. In this
Right.
situation, that was never, so we never had to deal with a situation like that. The person didn't
Yeah.
clean up all his business before he left.
Right.
We had to like just pick up the pieces and roll with it.
Right. Right. Man, that definitely sounds like a huge project, challenging project, and it doesn't sound like it's for the faint of heart. It sounds like you guys got your work cut out for you, but once you get it done, though, man, you're gonna have something nice there.
Yeah. I mean, we've made a lot of progress in 6-7 months, and things are starting to stabilize already for us.
Yeah.
We've come a long way. The paper put a big article for us, showed that, these guys doing this. They're the ones who got the idea of the fixer upper deal, because they put like, major fixer upper.
Yeah.
And when they put that out, a lot of people start saying like, these people are here, they're invested in the community, they're trying to fix things up. And it's good. That's when I started branding my name, and
Right.
And that's when I started the stuff I was dealing with was just so surreal that I was like, and then as soon as we started the documenting with the videos and stuff, it's like the drama just like chilled out.
Right.
And things have been I mean, there's always issues on a daily basis I have to deal with, but
Yeah.
it's not like putting out fires left and right anymore like it was. I mean, we were hit the ground running when we finally took over, and we just, getting people stabilized, getting the proper people in place to do things. And it was.
Right. Got you, man. All right, so man, let's go ahead. Let's go ahead and segue into the last segment of the show, man. Some lightning round. 5 quick questions for you. All right, so the first one is, what's the best advice you ever been given?
My father just said, be patient, and that's with this game and this business. It's a patient business. It's a long-term play.
Yeah.
It's not about quick money for us. It's always been about, we've built up momentum over 40 years, and I've got my good 20 years in. So patience, slow and steady wins the race.
Right. Great advice. What's the best book you've ever read in the last year?
The best book I've ever read, like that, I think it knocks Think and Grow Rich and all these books out of the ballpark. It's called a book called Creating Money, Keys to Abundance. And I'm going to start doing a series on it. I've had it for over 20 years, and like a book's like falling apart. And I visit it every few years, and it's a spiritual book, and it really like guides you into like aligning with your soul purpose and learning to listen, and to really tap into your inner abundance and change your mindset from within.
Yeah.
And create money, manifest money, and understand that money is an extension of energy and a part of the world, and that it really begins with inside of you.
Yeah.
Everything comes from the inside out.
Right.
As within, so without.
Right.
And if you clean up within, then the outside starts to change as well. People want to change everything on the outside, but they don't want to change themselves.
Yeah.
So Creating Money, Keys to Abundance by Sanaya Roman.
Yeah, it sounds like a good book, man. I'm gonna look that one up for sure. What are some rituals that you're doing right now that's making you a better person?
Meditation. I'm really starting to get back into my spiritual game this year. I never really left it, but kind of like reinforcing and get more, back to the basics, taking that quiet time, And, you know, because the head can just keep going, especially with all the issues I deal with on a regular basis.
Yeah.
And so I need to connect to something else other than this.
Right.
I need to connect to my spirit, my soul, and feel that, and come back to it throughout the day. You know, as I'm driving, as I'm thinking through something, the situation, I get heated or whatever, I got to come back to what I'm feeling inside, my connection to my spirit.
Yeah.
You know, is my ritual.
Got you, man. That's good. All right. So, what is the one thing you're focused on right now to help you improve your business? Like, what is that one thing you're focused on?
Only reason I laugh because there's so many things, you know. There's so many things in this business that I'm dealing with. I deal with managers. I'm dealing with paying bills. I'm dealing with so many things. And the one key thing for me is learning at this point in my life and at this point in my game, the one is managing people, you know, being a leader of people.
Yeah. That's I mean, that's something that's going to always got to be working on, because people, you know, they're not robots. I mean, everybody got different personalities. So I imagine, man, that's a tough one. And
the big key lesson I learned last year was, like, you know, there's people that you have to, you know, hold the vision, and there's people who implement the vision.
Yeah.
I was trying to do both. And it's very hard. You can't do both. You need to have people to implement the vision, but you have to be clear about your vision.
Right. Very, very true. Very true. All right. Last question for you, man. If you can give your younger self one advice or one tip in regards to, you know, investing, what would that be?
Man, a couple of years ago, just go all in, man. There's deals that we walked away from that all of a sudden, right before then, they're now all of a sudden they're doubled. Yeah. And that younger self was just 5 years. It was just 4 or 5 years ago, younger self.
Right.
You know, we'd have bought more property at that time when those deals were hot. When those deals were out there, we would have just bought.
Yeah.
Away from nothing. We would have closed every deal.
Wow. Man, that said a lot. For sure. All right, man. Well, you know, I appreciate you coming on the show today, man. That's the end of the show. Tell my listeners, how can they get in touch with you?
On Instagram, we're SNS Properties Investment, S as in Sam, N as in Nancy, S as in Sam again, SNS. Properties Investment, Properties Investment. And then Sharma's Karma is our YouTube channel. Look at Sharma's Karma. Check out our Karma Cast, you know, and the Karma Cast is now on iTunes and Spotify and those different channels. We've just started with that. Yeah. And we're basically just right now talking to local people in our local area, getting people, you know, and we do a live cast right here. Yeah. At the Love Palace.
Yeah. Gotcha, man. Well, hey, man, I appreciate you coming on the show today. Let's definitely stay in touch, and I'll let you know as soon as this thing goes live.
All right, let me know when you got those deals for me too, Willie. I know you got something in the pipeline. All right.
Most definitely, man. I keep you in touch, man. I definitely keep you tuned in on what I got coming up.
All right, brother. Appreciate you taking time. Thank you.
Yes, sir.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.